G'day, it's Matt, and I'm just recording this quick market update for early 2026. We've had a lot of phone calls of people asking what's going on in the market, what's happening down south in Wollongong and further south. So I thought I'd just record this quick video for you. And really, if we start by zooming out, we have to think about where are we in 2026. We're at a point in time that is really, I think, the great reset post-COVID. What we had in 2019 and 2020 was a tightening market. There was growth coming. The market had been warming up before COVID hit. COVID smashed everyone's assumptions and changed the rules. It brought forward all kinds of radical shifts like sea changing from people who'd been dreaming about it but hadn't done it. And so we saw 3 years where property prices grew between 80 and 100% on the South Coast. Some of the suburbs like Austinmere and Thirroul were Australian records for capital growth at the time for particularly higher price suburbs. 38% in a year just is not something we see very often. So that happened. We had our COVID kind of shift. Everyone remembers it really well. And at the end of that, it's like the tide coming in, it has to go out. And so after 3 years of radical growth and a huge amount of sustained increased demand for the South Coast with no extra houses, so all of that pressure went into price. After that, we saw a really quiet 2023 and 2024. And that was also at the time where we saw a whole lot of consecutive interest rate rises. And a lot of people kind of went back to some kind of a post-COVID normal, and some people wanted to return to the city. Some people's employers asked them to return to the city. During that time with the rate rises and that kind of new normal starting to set in, we absolutely saw, I think, a little bit of price fall off the top of that growth. And it's actually, if you go back the last 50 years, it's actually really normal after a boom to see a small price fall. We saw, as I said, 80 to 100% capital gains in 3 years. You can't sustain that, and people's affordability and borrowing capacity can't sustain that. We didn't see prices fall anywhere near back to the pre-COVID levels, but we did see price falls around about 20%. And I would say that's on par with the extra growth that we had during COVID. And so through those 2 years, and the interest rates going up and people's priorities shifting, a lot of people going into, back to international travel, we saw that price dip. What happened in the second half of 2024 into 25 is that the market recovered. And a lot of people didn't think it would. A lot of people were calling for ongoing price drops or sustained price falls. We actually didn't see that. We saw a recovery. There was a really constrained amount of supply. And we'll talk a bit more about supply and demand in a minute. But what we found is that prices recovered first in markets like Wollongong. And we've now seen the prices over that 18-month period recover all of those losses. So that 20% fall post-COVID has now been eclipsed, and we're seeing suburb records in Bulli, in Woonona, even in markets, like Dapto and Lake Illawarra. So right across the Illawarra, we're seeing those price changes. So we've really now seen a lot of suburbs in the Illawarra actually move past their post-COVID peak. So that price fall, which depending on which suburb we're talking about, was anything from 12 to 20% from the COVID peak, has now been recovered, and we're now into fresh price territory. And a lot of suburb records being set in suburbs like Bulli and Woonona, and even suburbs further south, we're seeing those new gains being achieved. And so there's really no sense in which the South Coast market, certainly from the Shoalhaven north, is really still hanging on to any of that kind of history. It feels like we've got a whole lot of fresh buyers and fresh sellers who are moving on with life. There's fresh money coming out of places like Melbourne and Canberra and Sydney in particular. It's obviously the biggest single relocation market that we see. A lot of people who want to escape the city come to the coast, kind of like my wife and I did 18 years ago. So it's definitely, I think there's a buoyancy in the market in the Illawarra that wasn't there early last year, for example. And probably 3 of the last 4 transactions that I've been involved in for clients in the Wollongong suburbs have had multi-bid situations. So that's now normal. Price activity is really interesting up in the Wollongong market. We are seeing a mixed bag. And I would say that Albanese's 5% first home buyer incentive has had an impact in the market in Wollongong sub 1.5 million. There's been a heap of activity and a lot of buying competition for good family homes with decent backyards in the 1 to 1.5 price point. And that's been one of the most challenging buying segments for us. We've had a lot of first home buyer clients recently trying to buy in that space because they've been knocked out of the market 3, 4, or 5 times. So that definitely is an active buying segment and a price point in the Illawarra where we're seeing, I think, price growth right now. We're seeing fairly aggressive buying behavior, and you have to move fast. If it's a good home and it's a fit for you, you need to move really fast. What I would say is that above 2 million, the market is patchier. It's moving a bit slower, and it's very dependent on how good is that property, how much does it, is there product market fit? Is it what buyers really want today? Are the renovations on point? Are the views really amazing? If they are, it'll still sell and it'll get a great price. If it needs work, if it's a little bit off kilter, if there's something wrong with the aspect or the views, or it's just half finished, I think we're seeing those properties are still selling for slightly probably softer than what vendors may want or what agents may be hoping to achieve. So there's still opportunity to negotiate a deal, particularly in that $2 to $4 million price point. I think there's a real variability in how those properties are performing in the Illawarra today. As we move down the coast, we're seeing, a great variation. I think the Shoalhaven, so Kiama down to Narooma and then to the Mollymook Ulladulla market, we're seeing that is a balanced market. We're seeing strength return and money's buying activities picked up from 6 and 9 months ago. But we're definitely not in any kind of boom territory yet. So I think that ripple that's pushed from Sydney out into Wollongong is just green shoots, kind of early signs of that hitting the kind of Shoalhaven market. And we're definitely seeing a fairly even tension between buyers and sellers, and there's opportunity to negotiate. So I think it's really just a case of be careful and pick a property that's a fit for you, and then, negotiate as hard as you can. Places aren't selling for ridiculously cheap prices. There's no great wash of really motivated sellers who are selling en masse and prices aren't falling anymore. They've really recovered post-COVID. Whilst up in the Illawarra, we're seeing prices 5 and 10% above their COVID peak. I would say in the Shoalhaven, we're probably more like at parity. Definitely, I think in Narooma, we've seen about a 5% price growth above the post-COVID peak. And down in Ulladulla, I would say we are right bang on 4 to 5% as well. As we head down the coast, that price growth lags, meaning that ripple is a slow-moving ripple, and you can actually kind of step back in time a little bit, which is super interesting because we all want to go back in time when we're buying real estate. And the old adage, they say the best time to buy a house is 30 years ago, and the second best time is today. Well, we can't go back 30 years, but we can kind of go back 6 to 18 months if we head down the coast in terms of how that behavior has happened. The price growth from COVID was a year or two later in the far South Coast. And that dip has really only just started finishing. So what we've seen from Batemans Bay down, and particularly those bigger, better coastal markets like Narooma and Merimbula, which for some of you, you may never have been there because it's a long way down, right? It's sort of 5 hours south of Sydney. But those markets have stunning beaches and mild climates, and there's a whole lot of retirement activity and sea change activity that does happen on that far south coast. And what we've seen is that the post-COVID peak is just recovering really quite recently now, and the price growth was really muted in 24 and 25, and it's just recovering now. And that's, an opportunity, I think, because of that market. The last 2 properties that we bought in the Narooma area, for example, for clients, both had significant ocean views. One was a second row home, so it had a home between it and the water, but it was high on a hill, so it had these panoramic north-facing views up the beach at Dalmini. And we were able to really negotiate hard on that property and secure that property below 1.4 million. The other was a slightly more rough and ready renovation project, but it was front strip. So it was oceanfront with just a coastal road between it and the beach. No major traffic. It's not a highway. We're talking, fairly moderate traffic on those roads. But front strip for well under 1.5 million with only cosmetic renovations required. And during COVID, that would have been a 2.3 to 2.6 kind of proposition. So I think there's still some fantastic value on the far south coast. I think that anyone who's considering making that move, and if the time is right, then there's still some good buying down that market. What about for investors? I think the take home for investors, because I get a lot of people asking, is it a good time to invest? And that's probably a topic for another video. But the two things that I would say we can pretty safely say, number one, vacancies are tight. So if you're going to buy a property and rent it out, and this is true, Australia-wide, you need to be looking at vacancy rate as one of the most important metrics that you're thinking about. And if that vacancy rate, and this is, we'll talk about that in a separate video, probably understanding on a much more granular level what is vacancy rate. But vacancy rate is how many rental homes are empty and how many are full. And we want that number to be as low as possible because we want every single rental property occupied. That's what keeps you safe as an owner. It means that the rent will probably grow next year. It means that your tenant wants to stay because they don't have 25 other homes they could move into down the road next week. If that vacancy rate creeps up, it means the market is what we would call soft. There's too many houses for the tenants. That's not a situation we ever encourage our clients to be in. The good news for the South Coast is we've got incredibly tight vacancy rates. A balanced market for vacancy rate is just over 2%, probably around 2.2 to 2.4%. So that's 2 to 2.5% of the homes that are available for rent in a given suburb, they're empty. And that means that you can't really put the rent up much as a landlord. And it means that the tenant and the landlord are in fairly equilibrium in terms of what is market rent today and what will it be next year. When vacancy rate dips down to 1% and below 1%, we see rents grow and they grow faster. So the lower the vacancy rate, the faster the rent grows and the more opportunity you have to see your yield grow in the second, third and fourth year of owning that property, which is actually what we think is super important. If you're going to buy an investment property, the rent you get today matters, but what matters more is the rent you get in years 2, 3, 4 and 5. And we want that consistency because we really advocate for long-term investing. Vacancy rates down the coast, if we look at the northern side of Wollongong, for example, 0.4%. Dapto, much cheaper suburb, 0.8%. Oak Flats, 0.8%. As we head to Narooma, 1.1%. Ulladulla, 0.8%, incredibly tight. Even Sanctuary Point, which is a slightly softer market, vacancy rate 1.5%. It was, last year it actually crept up over 2, which was around a balanced market, and it's come back down to 1.5. Batemans Bay 1.5 and Narooma 1.4. So up and down the coast, there is a fantastic strength to the rental market, even though yields are not spectacular. So if you're going to buy a high yield cash flow property, it's possibly not the easiest place to do that on the South Coast. We need to target dual income, or we need to be buying an older home and building a granny flat, for example, to get you extra cash flow. And there's certainly clients of ours who've done that successfully. But for an average home with an average yard in a suburb of, say, the Shoalhaven, you're really looking about sort of that 4% yield at the moment. But the key is that the vacancy rates are so tight that you can be pretty confident that that rent's going to be there and that it's going to grow in the next few years. What else do we need to think about if we're investing? I think that the other key metric you really want to be looking at in 2026, if you're investing on the South Coast, is the stock on market. How many homes are available for sale compared to those that are being purchased? And is that ratio healthy or not? What we saw post-COVID is that, during COVID, we went to record low levels of stock. No one was selling and everyone was buying. That's what causes a 30% capital growth in a single year. After that, in the 2023 period of rate rises and kind of shifting priorities, we definitely saw a softening, and that looked like a growth in the number of homes available for sale. So we call that increasing stock on market. For context, it wasn't huge, right? There was no great glut of properties, even though the media was putting out articles saying there'll be, with the rate rises, there's going to be blood in the streets and thousands of forced sellers. It didn't happen. Not even close. The amount of stock on the market at the peak, which was the end of 24, Christmas 2024, was where I saw the most homes for sale available. And it was kind of the easiest buying, as it were, because we could go and look at a dozen homes and pick and choose, and we were the only buyers around. That was lovely for us and for our clients at the time. But the reality was that stock level was still half of the stock level that was happening back in 2010, 2012, 2014. So the market wasn't that soft if you look at a macro history. If you look back over the last 20 years, it wasn't a big peak. We didn't see a huge glut of properties come on the market. And since Christmas of 24, stock has been tightening right up and down the coast. It happened earlier in the Wollongong and Shoalhaven markets, but it's already happening on the far south coast as well. And we're now entering incredibly low stock levels for key suburbs in the Illawarra and key suburbs in the Shoalhaven. So that stock level is trending down, and I've got graphs that we look at kind of every month to track that stuff up and down the coast. And I'm 100% convinced that we are in a low and probably a falling stock market at the moment. In 2026, what will we see? Will that continue? That's a crystal ball question, I guess. I don't really want to make predictions because there's a bit of uncertainty at the moment about will we see rate rises or rate falls or just a stable interest rate in 2026. Even with a couple of rate rises, I don't see stock levels changing much. It would take a lot of interest rate rises for any kind of mass forced selling to happen. What people underestimate is just how many people on the South Coast own their homes outright and how many people on the South Coast have heaps of equity and quite a lot of savings. It's not an area that has historically been highly leveraged. There's not a lot of speculative activity here. I think certain investor markets in capital cities where the hot spotting, borderless buyers agents take people and where people go to speculate on apartments off the plan or on new house and land packages, they're far more risky and cyclical suburbs. Established markets next to the beach where there's small but really stable communities, they just haven't seen that kind of speculation. And so I believe we're going to see really low stock levels in 2026. And I can say at the moment they're falling. So that's something we can say without, trying to game the system or crystal ball too much. With those two metrics, vacancy rate and stock on market being in our favor, I'm quite bullish on prices in the Shoalhaven. I don't see them getting cheaper. I think that we're early enough in the property cycle that we're not paying overs. We're not at the end of a boom. We're actually starting that next cycle, and I think with fairly consistent monetary policy, it's likely that the next year or two ahead will be steady as she goes with some growth, and blue chip assets close to the water, they're going to hold their value. They're going to sell, and there's going to be 2, 3, 4 buyers for every property if they're good. Anything that needs work, I think the opportunity for people who want to invest and get value and buy a little bit more affordably, you need to know which vendors are highly motivated, and you need to be willing to buy that ugly duckling. I think if you can do some cosmetic renovations on the South Coast in 2026, it won't be a waste of time. There are some moments in history where there's just no extra value. There's no equity created by those kind of renovations. But we've seen some clients recently taking on those projects. And whilst it's not a get-rich-quick scheme, I think there's opportunity there to buy a better asset than you could have otherwise afforded. So getting as close to the beach as possible, getting the biggest view as possible, or the best set of bones that you can. I think that's a fundamental opportunity for people to consider. And it's a great long-term outlook. I hope that's helpful. I've tried to summarize both the home buying, the beach house opportunities, and the investing kind of metrics that we think are those core ones. There's obviously a couple of opportunities for us to record videos on specifics of that, but that's my 2026 market wrap for the South Coast.